Hello and welcome. My name is Eric Philippink. I am counsel here at Trinity International's Washington, D.C. office, and I would like to thank you for joining us for today's edition of Trinity Talks. We had delayed the start just a few minutes so that we could have all of our expected attendees to show up. Trinity Talks is our monthly series of short live stream presentations where we discuss a topic of interest to the development finance community. Our presentations are usually about 30 minutes in length, so they are short, followed by about 10 to 15 minutes of question and answer time. I would like to thank all of you for joining us for today's presentation. Our presentations are given by Trinity attorneys from one of our 3 offices in London, Paris, or Washington, D.C. And we also like to, from time to time, bring in guests from industry, from the development finance sector, so that we can hear from them speaking about their experience directly. So for today's presentation, we will be hearing from our partner in our DC office, Tom Eldert, who will be leading us in the discussion on political risk insurance. And joining us in the course of the presentation will be our guest speaker, Connell Duffy, who is Vice President from Alliant Emerging Markets, a public risk insurance provider who is based in Chicago. And so as we begin today's presentation, I am going to turn the floor over to Tom, who will be leading our discussion in just a moment. And will be walking us through the presentation. I'm going to now turn to the slides, and if Tom, you could give us a voiceover and walk us through the agenda.
Great, thank you, Eric, and welcome everybody. I think this is a relevant topic these days. I mean, there's certainly a number of political risks, both new and others that have been going on for a long time in the world. For our agenda today, first we'll have the introduction. What is political risk insurance, or PRI? We'll talk about coverage, what is available for coverage typically, key policy terms and conditions, in PRI providers and how you may want to choose, market trends, tips, conclusion, and Q&A.
And we should point out that for those of you who have questions, you can send those through on the chat button on your Microsoft Teams software. We will save the questions and answers for last after we do a wrap up of the presentation. So please start, Tom.
So generally, what is political risk insurance? Political risk insurance covers losses to investments and financings that result from adverse government acts, including breach of contract, expropriation, and contract frustration. It can cover currency and convertibility and political violence. It essentially covers country risk for investors and lenders. In certain cases, contractors as well. The benefits, you get compensation for your loss, so it mitigates the risk of loss for your business and your equity, or your loan as the case may be. It can also serve as a credit enhancement. So if you're particularly doing a project in a higher risk environment that lenders may be hesitant to go into, they'll either charge a high risk premium or they may not be willing to finance your project at all. If you have political risk insurance on the loan, or even sometimes on the equity, that can serve to enhance the credit and the both the attractiveness of your project and also potentially reduce the risk premium associated with any financing. Political risk insurance can also deter or help resolve harmful actions by the host government. This is particularly true if you are insured by a public institution, which we'll get into later, that may have political power by on the part of the host of their own government, or in the case of, say, MIGA, the international community. And that can be extremely useful in terms of both preventing a government from defaulting on an arbitral award, for example, or expropriating a project, as well as if they start to do those actions, reaching a resolution that stops short of resulting in a total loss of the project. And finally, it can be a catalyst to project funding. It can assist, particularly on the equity coverage side, in attracting investors who may be otherwise hesitant to invest in the project. We also note that it's generally separate from terrorism coverage, and so we won't get into detail on that here. But you can combine the two policies if that's relevant to your project. In terms of coverage, there's 5 general categories: currency inconvertibility, confiscation, expropriation, and nationalization, political violence, breach of contract or arbitral award default, non-honoring of sovereign financial obligations. There can also sometimes be others, but these are the main 5 that you see. There's also, quote unquote, add-ons to expropriation, items like selective discrimination, deprivation, forced divestiture, or license cancellation. And similarly, for political violence, you may have coverage for business interruption, forced abandonment, interference with operations, and contingent business interruption. So broadly speaking, confiscation, expropriation, and nationalization, or CEN, it covers adverse acts of the host government that result in the confiscation, expropriation, and/or nationalization of assets, rights, or obligations, including to repay debts owed to investors and lenders. It can also include cover for deprivation or the inability to export, such as after an equipment lease expires. Now, it's, I think, also worth noting that that's a pretty broad description, and so something you want to pay close attention to in the policy wording, which we'll get into a bit later, since expropriation can stray into the gray area when you get into issues of government regulation and what's called creeping expropriation. Next is political violence. Political violence includes typically cover for physical damage losses resulting from acts of war, civil war, terrorism, coup d'etat or insurrection, etc., caused by organizations or groups of individuals with a political intent, and that's really one of the key components for the cover. Some insurers may also agree to cover losses from strikes, riots, civil commotions, malicious damage, sabotage, or other acts by organizations or groups of individuals with political intent, again. The compensation typically covers the cost to repair and replace using an actual cash value, or as you may otherwise agree when you're negotiating your policy. There's no waiting period generally for political violence, and claims can be amended as more information becomes available, since obviously political violence actions tend not to be a one-time single event, but build up over time and can go in waves. Breach of contract or arbitral award default. This is pretty common for power purchase agreements, production sharing, concession agreements, concessions, basically any type of arrangement, particularly monetary, with a government entity. Similarly, it's often used for sovereign guarantees or the obligation of the host government to guarantee the payments of another entity of the host government. And finally, it can cover bilateral investment treaty or BIT arbitration awards as well. Then we have non-honoring of sovereign financial obligations. This can include Ministry of Finance commitments to project funding. So we note for public insurers, for example, DFC and MEGA, this can be viewed by lenders as a guarantee product, not insurance, but gets you more or less to the same place. Whereas private market insurers have products that are like those, as well as their own forms, and the latter are often considered to be insurance as opposed to a guarantee product. So next we'll talk about key policy terms and conditions, and we'll just do this quickly. First up is tenor. This is basically the length of your coverage. I'd say, this varies obviously depending on the deal and the insurer, but the average is generally between 3 to 5 years. They can go up to 15, or maybe for certain insurers or certain deals more, but that's generally the long end for a lot of insurers is 15 years. Premium payment, that's obviously critical if you're the insured, how much are you going to be paying? And that's a commercial negotiation. But you can also discuss whether or not you're going to be paying the entire amount up front, or if it's going to be periodic installments. Cancellation by insurer. Generally, the insurer can only cancel if there's non-payment or another material default. Whereas cancellation by the insured is generally permissible, although it's not uncommon to have a period of time, particularly in the beginning of a longer coverage period, where you can't cancel. So you may not be able to cancel in your first 2 to 3 years, for example. Your coverage will have deductibles, and that can be either a specified amount or a percentage, which essentially ensures that there's some risk sharing between the insured and the insurers. Salvage and subrogation. This essentially gives the insurer the rights to step into the shoes of the insured in the event of a total loss. So they can take over the project and try to collect whatever they can to recover at least part of what they've paid out to the insured. So essentially, if you're the insured and you submit for a total loss claim, you get your money, but you're completely out of the project, and that's the end. Waiting and limitation periods. These are generally at least 30 days before claims are eligible for a payment, and this, in other cases, it can be longer than that. And this basically just gives time for additional information to become available, for there to be clarifications, and also to potentially resolve the issue. And I think particularly in the case of public institutions and coverage regarding government entities, they'll want that additional time to be able to see if they can prevent the problem in the first place, which really results in a better outcome for both the insured and the insurer. Notification and time to submit a claim. There are time periods that will be in the policy you want to pay attention to in terms of how quickly you have to notify the insurer of covered events or potential covered events. And there'll also be time limits on how when you can submit a claim, that you can't sit on it for 3 years, for example, and then suddenly make a claim. And similarly, after the policy expires, there'll be some period of time after which you can no longer file a claim, and obviously you can't file a claim if the event occurred after the expiration of the policy. Next up is causation. This essentially states that the covered event has to be the cause of the loss, and generally the direct or primary cause of the loss. And this is something you'll want to pay attention to in the language and be sure that it covers what you expect it to cover. And it's a pretty common issue in claims. We had one claim where there was a claim for political violence, and the fact pattern was that there was a power project, and in the country where the power project was, there were insurgent attacks against power lines in a different part of the country. The attacks against the power lines affected the energy market, which caused the government to issue regulations that changed the tariff structures, which the insured claim then led to a loss because they were unable to collect what they expected to collect, and their project was no longer financially feasible. So they essentially claimed that the political violence led to the government regulation which caused the loss. From the insurer's perspective, that certainly did not seem like direct causation. Proof of loss. So in the event that the insured wants to make a claim, the burden of proof is on the insured. So the insurer will need to see significant evidence that the loss has actually occurred and that the covered event was the cause of the loss. A duty to minimize loss. The insured has to act as if it was uninsured. They can't simply say, there's an issue with the government, no problem, we don't have to do anything because we're insured. There is an obligation to act as if you are not insured. Cooperation with insurers, including on recoveries. So there's a general obligation, which makes sense, that you have to cooperate with insurers, provide them with information and notices that they may need, and even after a claims payment, assist them in being able to recover if there's been a total loss and they've taken over the project. Policy limits and aggregation. So there will be limits on both each individual policy, and you may have multiple. You may have currency and convertibility and political violence and expropriation. There will be different limits or caps potentially on each of those, and even potentially on subcategories there, as well as frequently an overall cap, which is essentially the maximum exposure of the insurer. And then there will often be other policy terms, other terms and conditions that will be relevant that are really come up with on a case-by-case basis, depending on the nature of the transaction and the country involved. One other point just on this subject generally is that, while contract wording is obviously important in pretty much any contract, and lawyers will always say that because it's in our interest, I think it's especially true when you're talking about insurance policies, because you're trying to define very broad terms like expropriation that are often difficult to define, but keep it fairly simple. And so even one or two words or even punctuation can matter. So you need to be very careful with the language. The good news is that there's most of the insurers have standard forms that are pretty consistent. It's really, so the issue tends to be more, one, making sure you understand what's in there, and particularly understand what you're covered for and what you're not covered for. But two, to be especially careful when you're deviating a bit from the forms, when you're making changes that make sense for that specific deal. And just one example on that point, we were involved in a claim under a political violence policy, and our client's position was actually hampered by a comma that had gone missing in an earlier draft. So that seems kind of like the setup to a joke for why people hate lawyers, but in that case, just a comma actually made a significant difference in terms of the posture in litigation. All right, so providers. There's basically two different types of insurance providers. There's public insurers, and these are usually governmental institutions or agencies, as well as multinational institutions. And examples are MIGA, DFC, ATI, ICIC, Damen. There's also in Asia, there's Nexi, K-Sure, and Sinosure out of China. There's a number of others. One of the benefits people cite for using a public insurer is the so-called halo effect. And the halo effect is essentially the fact that you're not just getting an insurer, you're also getting the representative of that government, or in the case of MIGA, the international community. And that can, as we talked about earlier, have a very beneficial impact, and particularly when you're dealing with the host government, both in terms of preventing events from happening in the first place, but also in terms of resolving them and even being able to collect. Another thing to note on public insurers is eligibility requirements. You want to understand what the eligibility requirements are before you spend too much effort applying for insurance from them. And they will vary depending on the insurer, but there can be nationality requirements. Most of them have, because they have a developmental focus, there will be, some certain countries will be eligible and certain countries won't. Some of the public insurers are what's known as an insurer of last resort. And what that essentially means is they can't provide the insurance unless the insured has documented that they've tried to get insurance from private sources and have been unable to. So essentially, they can only provide insurance if there's no market in the private sector. And then finally, it's just worth noting that all of the public insurers will have their own policy requirements. These are largely environmental, social, they can be workers' rights, points like that. They tend to be a little more comprehensive and require a bit more reporting and monitoring than private insurers would have. So that can make transactions a little more involved. Private insurers, there's a number of them out there, and as noted in the second bullet, they're actually responsible for the majority of PRI policies placed. I think, while they may not have the same halo effect as public insurers, they do have the advantages of generally being seen as being a bit more responsive and flexible in terms of what they can offer, and particularly what they can tailor for a specific project. And then finally, there's reinsurers, which we won't get too much into, but it's basically reinsurers can be a method to increase the size of political risk insurance coverage that might otherwise be available by from a single provider by backing them up with additional reinsurers. So next up is you have your choices of providers. How do you choose? First, you want to check eligibility, particularly if you're looking at public insurers. Pricing, obviously, you're going to want the best deal you can get. But again, you need to not just focus on the price, but also look at, okay, what are you getting for that? And really take a look at what the coverage is, what are the exclusions from that coverage. Capacity and policy limits. Each insurer will have essentially a set amount of capacity that they might be able to provide to a project, and that's could be an issue if you're looking at really large projects. There's also policy limits. So if you have a $500 million project you're looking to get insured, some insurers will only be able to do or only willing to do a limit of, say, 200 million. Whereas DFC now, for example, after their recent reorganization, can do policies up to $1 billion. Alignment of interests. I mean, you ideally want to choose an insurer who has an alignment of interest with your activities in the projects. And on the public insurer side, this could include governments who are aligned with, as a policy matter, with the type of work that you're doing and the country you're doing it in. And finally, we note that you can choose more than one insurer for some transactions, and it may be necessary, as mentioned above, if it's a particularly large transaction. And there can also be what's called blended insurance with public agency and private market participation, so you can get the benefits essentially of both. I mean, you can have the halo effect and the advantages of the likes of MEGA or DFC or K-Shore, but then the additional capacity and flexibility of private insurers in the same transaction. And unfortunately, Connell had technical difficulties, since I know that's a big topic that he's interested in right now, and particularly on market trends. So if you have further questions on these, feel free to hit him up as well. We can give you his information. Market trends generally, the private market capacity is over $2.5 billion for any single project, which is down slightly over 2020, but not that surprising given what that year was. There's been an increase in interest for PRI, and PRI has been interesting because I've been doing it since 2002, and it definitely goes in waves, or it becomes popular and then crashes and then popular again. And it does seem like right now, for obvious reasons, we're on the upswing in interest. Public insurers, as noted earlier, as part of the change from OPIC to DFC, they've increased their ability to their coverage limit up to $1 billion per project. And we're also seeing more transactions involving public agencies and private markets working together. So tips. Shop around and mix and match if needed. I think a lot of people come to their brokers or sometimes their lawyers and they're fixated on one single source. They say, I'm an American company. I've heard of DFC. I'm going to get DFC insurance. They haven't talked to them or anything like that. It makes more sense to talk to a broker, particularly because they can be helpful and save some effort on your part. But look at all the options available and make sure that you get the best deal in terms of price, but also that offers the coverage that you actually need for your project. And again, that's where a broker can really be helpful. As mentioned before, check eligibility requirements before you start spending a lot of time chasing one single source. Understand what's covered and what's not. I've said this a couple times, but it's critically important because I think this is one of, as I mentioned, there's been a trend up and down in PRI insurance, and what historically has been one of the reasons for a decline in interest in PRI is basically a sense that PRI providers don't pay. That banks or other insured think they have a claim, it's denied by the insurer, and then they go away angry and say, well, I'm not going to use PRI anymore. Whereas really what in most of those cases, and we've been on both sides of it, often what it is just a gap in understanding between the insured and the insurer in terms of what the actual insurance policy covered. It's kind of the way I am, frankly, with my house insurance. So it's really important to understand what's covered and what's not. And then, before you've agreed to the policy, because then you can maybe negotiate for things that are not covered that you want or probably need. Negotiate deal-specific terms if needed. This is related, but particularly in terms of the description of covered assets and areas like that, it's important to be specific and comprehensive if you can. Just as an example, if your project is a agricultural, a farm, say in Kenya, and you export your products to Europe, and to do that, there's only one road you can use, and it goes to one single port that you can use. When you negotiate the policy, obviously your farm will be covered, but do you need to cover the road and the port? Because if the government expropriates the port or seizes the road and says it's only for military use, even though they haven't expropriated your project, your business basically may be done. So you want to be very careful to think about making sure you can insure as much as you can that you need for your project. Keep your options open. This kind of goes back to before, but keep an open mind and talk to different insurers and brokers. And then last, use a knowledgeable broker. So since Connell is not on, I can say this since he'd be too modest, but I think it is critical unless you've done several political risk insurance policies previously, or you're just kind of renewing one that you've already had, having a good broker is critical, both in terms of understanding the coverage, but also in terms of making sure you're getting the best deal that you can. So in conclusion, political risk insurance is a make or break. I mean, it is basically the difference between losing everything and, well, other than being a little disappointed, being able to walk away with some money and being able to start another business if something catastrophic does happen. Know your options, again, shop around, and work with experienced partners, attorneys and brokers if needed. I'd say, again, it is definitely useful to have a broker. For attorneys, if it's if it's complicated, it certainly can be useful. And I will note too that legal fees for these transactions, as opposed to like a project financing, are generally pretty low. It's really just a matter of making sure that the contract wording says what is needed, so it's not a particularly expensive endeavor. That's it. Thank you all very much, and we apologize for those of you hoping to tune into Connell, who's much more entertaining than I am. But
well, Tom, I would just like to thank you for your solo performance today, but we also would like to thank Connell Duffy for helping compile today's presentation. And once again, Mr. Duffy is currently the practice leader for political risk insurance at Alliant Insurance Services, which is a 4,500 person insurance solutions provider with offices across Canada and the United States. And Tom, I'm just going to leave you up for a moment because we have just a couple questions. And again, since you gave us your solar performance, you're going to have to field these questions for us. Back to the slide where you were discussing the different types of providers, both the public and private. Can you compare PRI cover to export credit agencies? Because we didn't mention those during the presentation.
No, I mean, it is similar in terms of if you take like Exim Bank, they are providing political risk coverage essentially, but they do it in a different structure. So it's not insurance, it's a guarantee in the case of Exim Bank. So they'll issue, they'll basically guarantee loans from commercial banks, but they're largely covering the same risk. There will be some differences, but it's a slightly different format.
Okay, and we talked a lot about obtaining cover and the various issues to think about for cover, but what about claims? Can you speak about the payment of claims? Do private market insurers pay claims? What about the public agencies?
Yeah, I mean, as I mentioned earlier, I think there is a misunderstanding or a myth that local risk insurers never pay. I mean, that's certainly not true. There's been a number of claims. I think the public insurers tend to have paid out less than the private insurers, but not because they're less willing to, but because they often have the ability to, it's the halo effect again. They can go in and solve a problem, particularly if it's a government. That, and they're often, depending on the insurer, fairly conservative in the projects that they insure. So again, I think it's a complete myth that the insurance companies aren't willing to pay. Particularly again on the public side, they're development agencies, so they're not doing it to make a profit. So they really have no incentive to not pay. I mean, their incentive is to basically salvage the deal, which may be pay off the insured, step in and see what they can do with it. And similarly, I think, the private insurers, while they are for profit, this is their business. So if they gain a reputation of basically selling a worthless product, then they'll be out of business pretty quickly. So no, I think, they do want to pay if there's a valid claim. Where the misunderstandings is insured not understanding what's covered and thinking any government regulation is expropriation, or any political violent act anywhere in the country should be covered. And that's where I think it's really important that the insured understand the policies. And I will say too that, I mean, particularly since like the mid 2000s when this was a real issue, the insurance companies have been doing a great job of explaining their product and working with borrowers and making sure that they understand it. So they're definitely not, the car insurance salesman that calls you on the phone. I mean, it's in their interest, and they do a great job of doing that.
Thanks a lot for that answer. And that brings to a conclusion our presentation for today. I just would like to also thank our guests for attending today's presentation. If you would like to get in touch with Mr. Duffy, please reach out to us. You can contact us if you do not have our direct personal details. Certainly you can contact us through our website, trinityllp.com, where you also will find links to all of our previous Trinity Talks videos, which are on YouTube. And we know that many of you who have participated in our live stream events will later on go to our website and click over to see the YouTube video. And so we thank you for that as well, because we know that the interest amongst the development finance community is high for these topics. So if you have any suggestions of topics, please contact us. We would like to make sure that we are being responsive to our clients, our potential clients, and our development partners. We have some upcoming topics here that are listed on this slide. The next month's topic will be battery storage, which is a very hot topic indeed. We know that that battery storage is becoming more and more crucial, particularly for resiliency in power systems. And then later on in upcoming months, we will talk about construction contracts and then the hotel and leisure sector, which will be just when the holiday period will be hitting us. Although, of course, with the COVID restrictions that may still be in effect, then some people's holidays may not be as enjoyable as they would have liked, but we are planning for the future. And so we are looking forward to talking about what the future may bring in the hotel and leisure sector. And so with that, I would like to thank everyone, and again, thank Tom for fielding today's solo performance. Again, look us up online, connect to our YouTube videos, and we look forward to seeing you on the next occasion for Trinity Talks. Thank you and enjoy the rest of your day.